Hello, everyone. Welcome to the Financial Prophet. First off, happy President's Day. While the official name of this federal holiday is President's Day, it's actually just George Washington's birthday. So, happy George Washington's birthday to everyone. I'm Victor Durganov, and in today's Prophet Report, we're going to talk about the White House and the Federal Reserve dynamic, which could turn into one of the most pressing subjects here in as we advance in 2025. So last week we discussed how the trade war tensions may not be as significant as previously perceived. We also talked about the market's bullish setup after the recent pullback. Now, despite some warmer than expected inflation data last week, the expectations for future rate cuts may have become too negative. Probability-wise, it's now a toss-up whether we will see just one or two 25 basis points cuts by the end of the year. So this is much lower than the market anticipated just several months ago, because the market was looking for at least 3 to 4 25 basis point cuts. This was before Donald Trump was elected to be the 47th president of the United States. Now, this dynamic could lead to volatility and other unintended consequences later in the year if the market only receives 1 or 2 25 basis points cuts, because interest rates are still relatively high, and which is a real problem for longer term rates, which affect mortgage rates and treasury yields and other longer term rates that are really impacting the economy negatively. So we really need to see lower rates, and the sooner the better. So potentially, in part due to this dynamic, a man called Kevin Hassett, one of President Trump's top economic advisors, will meet with the Fed chair regularly. So in a more optimistic outcome, we could still see 2 to 4 25 basis points cuts this year. Moreover, the economy remains highly resilient, the jobs market stable, and the recent uptick in inflation could have been a transitory phenomenon. Furthermore, we could see bullish factors like tax cuts, deregulation, targeted infrastructure spending, and other fiscal stimulus. Meanwhile, despite showing pockets of froth, the market has substantial growth drivers like AI and other significant segments likely to benefit and improve the general economy as we advance in 2025. Now, having said all that, let's take a look at the chart for a technical analysis and the setup. So the S&P 500 has been consolidating for about 4 months now. This has been a crucial post-election consolidation phase, and a move higher could come soon. So we've seen the initial 6,100, roughly 6,100 to 5,800 range narrow recently to about 6,100 to 6,000. So that's basically the new range that we're looking at now, and we're looking for either a breakdown below 6,000 or a breakout above 61 to 6150 resistance. Now, the probability seems relatively high that we could see a move to new all-time highs relatively soon. Now, I also want to mention that we recently witnessed about a 5 to 10% pullback in the S&P 500 and other major averages. So this is likely a bullish dynamic marked by rotation and some valuation and technical resets in key stocks and general market averages, which is something that we need to see every now and again in a healthy bull market in order to get the valuations reset to lower levels and get the technical conditions basically reset from their overbought stage to a more neutral level, like we see here now. Therefore, the S&P 500 could move to the 62 to the 6,300 resistance zone soon. Having said all that, technically, we also have a very interesting week from a fundamental perspective ahead. So let's take a look at what we have here for this week data-wise. So we have a very interesting week data-wise. First of all, happy President's Day to everyone again, as we have a holiday, basically a holiday today in the U.S. On Tuesday, President Trump will speak, which could be a market moving event leading to market moving consequences. Whether that's going to be an up or down market moving event, only time will tell. Now, likely transitory if it's a down move. Moreover, on Wednesday, we will receive the FOMC's minutes, which could shed light on future rate cut prospects and basically other prospects for the economy. Now, on Thursday and Friday, we will receive other crucial data like jobless claims, manufacturing, oil, existing homes, and more. So we don't really have any real crucial readings like jobs reports or inflation readings like super crucial, but we do have some relatively important readings that have the potential to move markets this week. Now, last week we witnessed higher than expected CPI and PPI inflation, yet the retail sales data came in weaker than expected. Therefore, we're seeing some divergences and uncertainty within the data points. Now, this dynamic has caused the FOMC's rate cut probabilities to fluctuate a bit. So let's take a look at the June probabilities here. So for June, there's basically about a 50-50 probability, actually a 51% probability for at least 125 basis point rate cut by the June FOMC event. However, despite the slight likelihood of a rate cut, there is also about a 49% probability that rates will remain as they are now in June. Now, if we look out going further out a little bit, we see that the probabilities increased to about 75% for one rate cut or more by September, and there's also about a 15% probability that rates will remain as they are by the end of the year, which also increases the probability of a 25 to a 15 basis point cut to about 85%. And we see about a 50-50 toss-up whether we're going to see 25 basis points or 50 basis points worth of cuts by the end of the year. Now, some market participants are even arguing that higher rates are possible and there could be a rate hike later on this year. Now, I'm not in this camp, of course, but there is some talk about this. Nonetheless, I believe the market may be too hawkish and bearish regarding the future of monetary policy. Despite the CPI being slightly elevated recently, Trueflation shows inflation around 2.3% now. So let's take a look at our chart of Trueflation here. Now, much like the CPI and other government inflation readings, Trueflation was also above 3% in January due to the transitory uptick in inflation in recent months. However, we witnessed Trueflation inflation drop to about 2% in early February, and it's now around 2.3%. Now, this dynamic implies that we may see lower than expected CPI and PCE readings and other inflation gauges in future months, which could enable the probabilities for more rate cuts to increase. Therefore, the market may receive more monetary support than is expected now, as we could still see 2 to 4 25 basis point cuts this year. Now, let's talk a little bit about the Trump administration and how it is willing to, quote, work with the Fed as we move on. Now, since the Fed is an independent organization and it does not answer to the White House or the President of the United States, the Trump administration is making its own moves to work closer with the Fed to achieve the most optimal results possible for the U.S. economy. Now, the White House National Economic Council Director, Kevin Hassett, said on Sunday he plans to regularly meet with the Federal Reserve Chairman Jerome Powell to exchange views on the U.S. economy and to convey the president's opinion. Now, this dynamic implies that the President of the United States intends to play a more considerable and a much more active role regarding monetary policy and regarding the Fed than we saw from the Biden administration or from other previous presidential administrations. Now, this also implies that the President of the United States may exert some sort of influence over the Fed to achieve more rate cuts than the market expects now. So while the President of the United States doesn't have an official supervisory role over the Fed, we've seen what Donald Trump is capable of, and it seems more than likely that Donald Trump will try to play a more active role in what the Fed does in the future relative to monetary policy because it has such a huge influence on the stock market and on the U.S. economy and on so many basically different facets of President Trump's presidency and legacy that we will likely see the president play a more significant role to make sure that the Fed is at least attempting to be on the same page with the president. Now, in fact, this scenario reminds me very much of the 2018-2019 dynamic when the Fed continued to raise interest rates in the face of a weakening economy. Now, I'm not saying that we have a weak economy now, but if the interest rates stay elevated as they are, we could see some softness, and that is not what we want to see. Now, President Trump was vocal then, which may have contributed to the Fed's pivot on monetary policy then, and we could witness a similar dynamic moving forward. Okay, so let's move away from the Fed and the White House dynamic for a bit, and let's discuss this crucial earnings season that we had recently. Now, we witnessed mostly a better than expected earnings last week, and we've witnessed basically a better than expected earnings season in generally, with data showing 75 to 80% of crucial companies beating the estimates. Now, despite some minor misses from Alphabet and other quote underperformers recently, we witnessed solid guidance from most bellwether firms. Now, this dynamic suggests robust corporate confidence moving forward and likely higher than expected earnings results as we advance. Now, this week we will see earnings from Walmart, Constellation, Newmont, Medtronic, and on several other significant firms. Now, let's just dive into the valuation dynamic a little bit, because there's much debate about valuations and whether we may be around peak season valuation wise. For instance, a company called AppLovin, symbol APP, reported a better than expected earnings, released better than expected earnings recently, and its stock surged by a whopping 36%. Now, AppLovin has a 25 P ratio of about forward P ratio of about 80 now, and it trades at a sky high 30 times 2025 expected sales. AppLovin skyrocketed by about 750% just since the August low. And of course, AppLovin is not alone. Now, one of my favorite stocks, Palantir, is now trading at a sky-high valuation. I was very bullish on Palantir stock when it was $6 to $7. Then I was still very bullish when the stock was $15 to $20. And even in the $20 to $30 range, I was still very bullish on Palantir, because it had excellent growth prospects, much higher than the market anticipated. Its valuation was still relatively low to maybe inexpensive in the 20 to 30 range. Yet, due to its favorable market position and increased demand for its products and its stock, Palantir remains on fire, and its stock is now up by about 2,000% since its low of about $6 just about 2 years ago. And this was the time frame where we really built Palantir into my all-weather portfolio's most significant position. I still have a position in Palantir, but it's much smaller, ratio-wise to my entire portfolio than it was then. Back then, I had my Palantir position was about 10 to 15% when the stock was, when I was building the significant position, and it was my biggest portfolio holding. More recently, it's been scaled down to only about a 2 to 3% position. Now, here's why: because Palantir has a PE ratio of about 215 now, and it trades at around 72 times 2025 estimated sales. So, we also recently saw SoundHound AI, ticker SOUN, Crater, as NVIDIA exited its stake in the company, as well as its stake in several other companies. So we basically saw some stocks crashing on Friday because NVIDIA just said that it took profits on its investment. So SoundHound AI and other companies that NVIDIA was invested in basically saw 30%, 40% declines in a single day on Friday. Now, an argument can also be made whether Tesla is expensive, around a 100 PE ratio and roughly 10 times sales. We can even argue whether Microsoft and Apple and other stocks deserve to trade at 25 to 30 PE ratios. So yeah, there are definitely some concerns here relative to high PEs. However, if we look at our price to earnings table, we see that the forward PE ratio on the Russell 2000 is only about 24 now, which is relatively cheap, provided that it's a small cap index and that the domestic economy could potentially do well, especially with tariffs. And basically, the stocks in the Russell 2000, many mid-cap companies could do very well because they have increased exposure to America's domestic market, whereas larger companies have actually more exposure outside of the U.S. Many large companies, I should say. Now, with a forward PE of only about 24, the small and mid-cap index is relatively cheap here, illustrating that there are still many inexpensive stocks and many really good deals in the market. And we could say a similar thing about the NASDAQ 100, because with a forward P ratio below 28, it's really not that expensive from a historic standpoint. We can even call it relatively inexpensive. We should also consider that many of the mega cap tech stocks have relatively high PE ratios of 27, 28, 30, or even higher in some cases, which basically skew the NASDAQ 100 total PE ratio higher. So the equal weighted PE ratio is much lower, and this also applies to the S&P 500. So I mean, we could make the case that the S&P 500 is not that cheap with a forward PE ratio of 22 to 23. However, it looks much cheaper given its 19 equal weight PE ratio. So the equal weighted S&P 500 P ratio, it's 19, and it's also around the midpoint of its roughly 15 to 25%. Sorry, not percent, but 15 to 25 PE ratio. It's basically its median PE ratio over a 10-year time frame. So we see that the PE ratio has ranged from about 15.4 to 25.7 over the last 10 years, and right now it's actually right around or exactly at its 19.1 median PE ratio. So I mean, how can the S&P 500 be grossly overvalued, or how can it be considered to be so overvalued by many when its equal weighted PE ratio is only around 19.1, which is basically its 10-year median average. We can also look at the price to book ratio, which is 2.5, which is around 2.6 now, and it's actually slightly below its 10-year median of 2.65. So the S&P 500 equal weighted P ratio is around its 10-year median. This dynamic illustrates that despite some mega cap tech stocks and other pockets of the market being overbought or overvalued, in general, the average stock in the S&P 500 may not be overpriced. On the contrary, if we have higher than normal valuations in certain stocks, then we must have lower than anticipated valuations in many other stocks. So this phenomenon implies that we may see more healthy rotation ahead, and the market may not be as expensive as it appears from first glance. Now, I want to talk about the market's favorable setup a little bit, because it's important to highlight that despite the Fed's rate cut slowdown path, the Fed is still transitioning to a more accommodative monetary position, and rates are around a high level, likely to move lower and not vice versa. Therefore, we could see increased liquidity moving into risk assets, including high-quality U.S. stocks, implying we could see multiples rise much higher in future years. In addition to the favorable monetary environment, the market could see tax cuts, deregulation, targeted infrastructure spending, and other fiscal stimulus, which should be very favorable for stocks and could contribute to higher multiples in future years. Therefore, due to this bullish dynamic, I'm keeping my 2025 year-end S&P target range around 7,000. Now, let's talk about the all-weather portfolio a little bit. So the all-weather portfolio is up by about 9% just this quarter, in about the first 6 weeks of this year, which is considerably better than the S&P 500 and the Nasdaq's 3 to 4% gains. Now, several stocks showing excellent performance and showing excellent promise this quarter include Palantir, which is up about 65% this quarter, Meta Platforms, which is up over 20%, Oklo, which is up by about 150% just this quarter. I, by the way, took some profits on Oklo and also have part of the position under CCD hedge. Also Constellation, which is up about 42% this quarter, AEM and NEM gold mining stocks, which are up about 25% each this quarter, and many other positions that have appreciated by double digits just this quarter for the all-weather portfolio. Now, I also want to mention that while some core holdings have been slow to start the new year, we could see increases in top tech holdings as we advance in Q1 and Q2. In fact, we've seen many very constructive pullbacks and corrections in many high-quality companies, including Dell, Advanced Micro Devices, Tesla, Nvidia, and other top long names. Therefore, I remain confident in the all-weather portfolio holdings, especially given the intermediate and long-term outlook. Despite prospects for more near-term volatility, its outlook remains strong. Now, due to the solid setup and the robust performance, I'm keeping my all-weather portfolio 2025 full-year target return range at 45 to 50%. So that's my profit report. Please comment if you agree or if you disagree with me in some points. In any case, I want to thank you all for watching my profit report. If you enjoyed watching, please click, share, like, and subscribe. You can also follow me, Victor Durganov, the Financial Prophet, at seekingalpha.com. Thank you very much for watching my video, and have a wonderful day.